Hello, everyone, and welcome to TradeFinder Live. My name is Zach. I'm from support at Elliott Options, and I'll be facilitating this session tonight with our speaker, Rob Roy. I'll introduce Rob here in just a few moments, but first we need to cover off a few important details about the session. First and foremost, this is our live disclosure disclaimer agreement. If you've seen any of our prior sessions, whether it be a previous TradeFinder session or maybe an insiders meeting, then you've seen this. The main thing to take away from it is that we are not licensed investment advisors in the United States, so nothing is to be taken as personal investment advice. We do have this on our website, so feel free to read it in detail there or take a screenshot if you like, but that's the main gist to take away. All right, and so for this session, we only have one method for asking questions, and as you can see there, it's circled on the screen. That's going to be the Q&A window. So at any point throughout the session, please feel free to enter your question into that window, and at the end, it's a brief portion, but we will try to address it if we can. We do have the chat window as well, so feel free to write in any support type queries or anything along those lines for other attendees to see. Throughout the session, just know that Rob can't take questions from there, only from the Q&A window. Again, the session is a bit brief for the question portion at the end. So if we don't get to your question, just know it has nothing to do with the validity. We just only have so much time in this session. Other than that, I think that covers off all the important details. So at this moment in time, I'll introduce Rob Roy.
Hi, everyone. This is Rob Roy of EWO Options, and welcome to TradeFinder Live. Thanks for the introduction, Zach. And as Zach mentioned, we'll talk about the question part of the session at the end. But if you're new to TradeFinder, welcome. If you're watching us on one of the live social media streaming services, welcome. If you're a longtime subscriber, welcome to you as well. I know we have a lot of new subscribers based on last couple of videos that we've done on YouTube. If you are watching on YouTube and you haven't been to our channel, please do go visit our recordings on YouTube. I think you'll see that the commentary that we've had on the market has been pretty spot on over the months and years. So with that, here's how TradeFinder works. We'll go through and talk about the markets. It says the US market outlook, but we've expanded that based on requests from you guys, the viewers, to look at some of the international markets. And if you're only interested in trading the US market, I encourage you to still pay attention when we're looking at other international markets, because all of the securities that we're talking about are tradable on the US exchange. So we could have a security that has something to do with a different market, but it's tradable on the US exchange. And if it's a good pattern, you might want to consider trading it. Then we'll go through and look at a review of any closed Elliott options alerts. So you'll get an idea of the alert service that we use for our subscribers. And then we'll look at a review of previous case study considerations. And as we go through the process, I'll explain the difference between those two. In previous TradeFinder sessions, we'll look for a case study consideration for tonight as well, or have one in mind before we even start looking. And then at the end, with whatever time we have left, we'll open it up for a general Q&A. And that often amounts to you guys giving us your favorite stock symbols, and we see what our indicators have to say about those. With that, that's how TradeFinder works. So let's go ahead and get into it. And so we'll take a look at the chart. Let me just double check and make sure that's what you're seeing. Okay, so here's the chart of the market. And as you can see, we have a pretty vertical move to the upside. Now, the important thing to note here is we've been talking about this qualified zigzag for quite some time, which as of today became disqualified. So that was the, hang on a second, clicked on the wrong bar there. So I'll fix that. And then you'll see that we came down here and there was the zigzag down to the potential 100% level at 400, which would have closed the gap at 400. That's now disqualified. So we won't talk about that anymore because we took out that B wave correction with today's move. And today we had a gap up. So we've had this vertical move to the upside. And when we look at volume, you can see that even though we had average volume today, the entire move to the upside has been on lower volume than on the downward move. So we had this downward zigzag that we thought might extend to 100%. It stopped at 61.8%. 61.8% is a big fib number. I talk about that a lot. In fact, it's my favorite fib number. But from there, we've rallied back to the upside. on lower volume. So what does that mean? Well, if you looked at our last SPY update, we talked about the fact that this week there was going to be a rebalancing. We even played a clip from Rick Santelli, who talks about the bond market, bond auctions, etc., for CNBC. Rick is a friend of mine. I met him on the floor of the Chicago Merc way back in the days when he was on the floor there. And he's one of the guys that really instilled understanding the bond market to me. And this is going way back 20 years ago. As far as if you want to be a good equities trader, you need to have a good understanding of the bond market. And with all of the floor traders, he was one of the few that actually spent time talking to me. So we played a clip from Rick about the fact that this rebalancing was going to be money moving out of stock and into bonds. Was he wrong? Well, at the beginning of this week, certainly the opposite has occurred. Money has come out of stocks or out of bonds and into stocks. But are we at the end of the quarter yet? No, we still have a couple days to go. So I don't think that we can say that he's wrong at this point in time. In fact, I think that this could be a setup. There was one of the senior advisors from JP Morgan that was on CNBC today. He said the exact same thing, that the rebalancing numbers is money coming out of equities and going into bonds, and that's the requirement, and it's large. So are they setting people up? Now, the shorts have backed away. There's no question about that. The shorts have backed away. That's what's allowed the market to have this amazing vertical rally to the upside. So they're not involved yet. Will they come in and press the bets if the market does start to move back to the downside over the last couple of days of the quarter going into March 31st? So that all these institutions can fulfill their requirements of their spread between equities and bonds. That's what the rebalancing means. If you're not familiar with it, is they have these investment objectives and they have to follow them. And that means a certain percentage of money in bonds and certain percentage of money in equities. And so people that have done the analysis are saying that in order to meet those requirements, money has to come out of equities and into bonds by the end of the quarter, which is obviously March 31st, end of the first quarter of 2020. So the senior advisor for JP Morgan said the exact same thing that Rick Santelli said. So are they setting things up? Follow me on this now. If you know that you're going to be forced to, whether you want to or not, but by investment objective and by prospectus, you have to have this certain ratio. And that means you're going to have to take money out of equities and move it into bonds. Would you not want to try to spur a sell-off in bonds if you're going to have to buy them, right? You want to buy bonds at a lower price, and a rise in equities if you're going to have to sell the equities. So wouldn't you want to sell the equities at a higher price and buy the bonds at a lower price? That makes sense, doesn't it? So is that what's going on? I don't know. Purely speculating here. But there's a couple of people that I really respect that are saying that this is what's going to occur at the end of the quarter. Whether it does or not, we'll see over the next couple of trading days. But one thing I do know, and I feel very confident in, is this market rally is too vertical. We had a gap up today, which is almost like a blow off top. And as I showed you on the volume, it's on lower volume. We did have average volume today, but that's just too vertical, in my opinion, to hold. So we look at the 200-day moving average. We've gone straight through that to the upside. If you wanted to see, well, is there a big zigzag here? In other words, just take the entire move down. Is that an A wave? And then coming up here, it's at 74%. So if Ralph Nelson Elliott was still here, he'd say, nah, he doesn't really like a corrective move that goes past 70%. Technically, it has to hit 78.6 before it becomes disqualified. So it's still skating underneath there, technically, for the potential of a move lower. Is that happening? I don't know. I'm just showing you what patterns happen to be qualified at the time, and the fact that Ralph Nelson Elliott would not pay attention to that because he felt that once you got to a 70% correction, there was a high percentage chance you're going to get to 78.6, which is the official point of disqualification. So let's not talk about that, other than the fact that this move has gone awfully vertical. Now, the other thing that we've presented in the past is the fact that after this move to the downside, you could have a rip your face off rally. And again, I think this qualifies, followed by lower lows as the rally sucks people in, everybody thinking the bottom's in, 420 was it, and then you start to sell things off. The market is liquidity driven. So think about this with me. Are we going to have more liquidity or less liquidity going forward? And the answer is less. The Federal Reserve is going to be withdrawing liquidity. The commodities market is telling us that it's going to be soaking up liquidity. It looks like there's going to be lower liquidity in the equities market. Can we sustain this rally? I don't think so. But you know what? The market doesn't care what I think, and you shouldn't care what I think either. We should follow the charts. That's how you become a successful trader. You can't trade on what you think is going to happen, because often the market will do things that make no sense. And even if you have rational thought and you have good fundamentals behind whatever your opinion is, the market's going to do what the market's going to do. So you have a choice: trade by what you think is going to happen in the market, or trade what the market is telling you. And so at this point in time, the market is saying, hey, we've got this big vertical rally, but you've heard me say this numerous times. I don't like it when things go vertical, because when things go vertically up, often they come vertically back down. So is that going to happen? I don't know. We're just going to have to wait and see. And I think we're going to get a lot of information over the next couple of days. So those of you that are alert subscribers with Elliott Wave Options, you heard Zach mention the insiders meeting. We do that every Thursday night for our alert subscribers, and that's for alert subscribers only. So that's for them. They can ask questions directly to me. It's a longer session than TradeFinder, and we'll be talking about what happened at the end of the quarter in that session Thursday night. So if you've been watching TradeFinder, or if you've been following us on YouTube and you haven't become an alert subscriber yet, this might be a really good time, because what are you thinking? The mean guys are back. You got AMC and GameStop, and all those stocks are coming back. You know what happened last time they got all excited? That was right before we had the significant move to the downside. Or so we just replaying that? Are we doing a little deja vu here with the meme stocks? I think you have to be careful of that. And so if you really have no idea where the market is going to go from here, might be a good time to join us and become a subscriber at Elliott Wave Options. So our website is EWOtrader.com if you want to take a look at it. One thing I know is that gap is likely to get filled. We've gone too vertically. And even if all we do is come back to this 200-day moving average, what I think, and again, market doesn't care what I think, but with this vertical move, whether or not we retrace the entire move because it's vertical, I think there's a great chance that from this low, we get at least a 38.2% corrective move. Look where that 38.2% level is, exactly at the 200-day moving average. So I think there's a fantastic chance that in the near future, we come back down to the 200-day moving average, and then we'll reassess and see where things are at that point in time. That's what I think is likely to happen over the next several trading days. So, you put yourself out there, your opinions don't really mean anything. You just read the charts, and in reading the charts, I think that's what's likely. So that would be a move back to around 445 on the SPY in the not too distant future. So that's where we are as far as the SPY. Taking a look at the other markets, we'll look at the diamonds and the Qs. We're going to take a look at that as well. So hang in there. Look, you can see we have a bit of a doji on the diamonds, also a bit of a gap up, and not quite the vertical move. Notice the difference in the chart from the diamonds versus the SPY, where we had just one down day there on the SPY, and that happened to be last week when I said we're likely to get a pullback the next day. Well, we did, and that was it. And the market moved back to the upside. Well, the diamonds went sideways for a few days and then moved up, and then we have a doji here. It's not a perfect one, but it's a doji nonetheless. And if we take a look at volume there, you can see a real good illustration of how volume is just fallen off on this move to the upside, other than today. So we did have average volume on the SPY, just below average volume on the diamonds. But the same scenario here, I think, plays out, is the fact that we've had a pretty significant bounce to the upside and the market needs a correction. more on the SPY than on the diamonds. If we look at the Qs, I've talked about this numerous times, with an environment of rising interest rates, I think the Qs are going to underperform. Well, they didn't underperform this week, did they? They had a pretty significant move, just exactly like what happened in the SPY. And we traded right at the 200-day moving average today. We did close above it, but there's another gap, those gaps. And, you know, it makes this, the market doesn't always do things that really sets in line and makes sense, but it does make sense that we get a pullback, we do this rebalancing, we fill these gaps, and then we reevaluate after the next couple of trading days. Is that what's going to happen? That's what I think is going to happen. And so, you know, when you come on and do these videos, you put yourself out there and you make your opinions and stuff, even though the market doesn't really care what you have to say, it's a lot. But, you know, I've been around a while, so I've got some experience to back up these opinions. We'll see if they play out or not. You're watching this, so you'll know. And then we've had this 1030 cross, so that's a bullish sign. But we also have this gap, and I would submit to you that gaps in the Qs are a little bit more rare than in some of the other ETFs or markets. As you can see, as you look back in the charts, we just don't see gaps that often. And when we do have them, they get filled pretty darn quickly. So you can see those gaps that have been filled in the past. And I think that's likely to play out here on the top of the fact that we are overbought from where we are on the 10-day moving average. And I really didn't highlight that too much on the SPY, but it's the same scenario. You can see where we closed today. There's the 10-day moving average. We've been overbought for a few days. As we continue to go vertical, the more vertically we go to the upside, the greater chance there is that we come back down. What the market moves that tend to hold are the 45-degree angles. And when you start to go at a higher degree than 45 degrees, you have less chance of that move holding. So does anybody think we're just going to run right straight back and make new highs, with the Federal Reserve likely to raise 50 basis points in the next two meetings? The Federal Reserve is going to start reducing their balance sheet in May. Does anybody think that we're just going to run to new highs and it's going to not affect the markets at all? I would spend some time arguing with you if you did have that opinion, because it would be about the exact opposite of my opinion. But that's what makes markets, isn't it? People having opposing opinions. That's what makes markets. If everybody viewed the market the same way, we wouldn't have a market. So we have to have people that view market one way, and then people that view markets the exact opposite way. Buyers and sellers, longs and shorts, that's what makes the market. So going back to the Qs here, right to the 200-day moving average, a little bit of a gap up, some separation with the 10-day moving average. If nothing else, we're overbought on several of the indices. Maybe we just correct the overbought conditions and that's it. I still feel like we need at least a 38.2% fib correction, and I'll stand by that. Looking at the IWM, I mentioned numerous times that with the big rally, we hadn't gotten to the point of breaking out of that trading range that we were in between 190 and 210. Look what happened today. So here we go. Look at that move to the upside here, where the IWM actually did close above 210. But there's always a but, isn't there? A gap there as well. So everything gapped today. All the indices gapped today. All the markets gapped today. And to break that resistance level on a gap up, it would have a stronger chance of holding if that didn't occur. So what I'd like to do, and I'm kind of putting Zach on the cliff here, but if we could have, I would like to, what I want to do for our case study consideration for TradeFinder tonight is buy puts on a market. We can do it on the SPY, we can do it on the diamonds, we can do it on the Qs, or we can do it on the IWM. So there's four choices. So that's A, B, C, and D. So Zach, I'm wondering if you can create a poll, and while we're going through the rest of this, and I'm going through the rest of the markets, and we talk about our case study alert that was sent out to our subscribers and all, if we could get everybody to vote and then come back and figure out what the voters say. And if you can't create the poll, that's fine. Just everybody put in a comment on which of those 4 markets you think is going to be the one that's going to correct the most over the next couple of trading days. So again, the choices are the SPY, the diamonds, the DIA, the Qs, or the IWM. So you have A, B, C, and D. I'm curious, of all the people that are viewing, which would you like to do? Because we haven't done this before. I've always been the one that's picked the case study consideration. So I kind of want to do something different tonight and have you guys be involved, you, the viewers. And if you're watching on live stream, welcome to you as well. But which of the markets do you feel is most ripe to pull back over the next couple of trading days? So one last time, A is SPY, B is the DIA, C is the Qs, and D is the IWM. So you guys vote. You're going to be the ones that pick the case study consideration that we're going to use for TradeFinder tonight. So we'll see how it goes. So I didn't mean to put Zach on the spot there. But if we can't do the poll, then just send in the, Zach will make a comment to you, and not enough time to create the poll, and you guys just write in which of the markets, and then we'll add it up at the end and see which of the markets created the most response. But interesting that we finally broke above 210, but we did it on a gap. So then we want to take a look at the volume. Is there enough volume there? Well, better than it's been the last few days, but not even average volume on the break. So we're going to gap up on below average volume, and that's going to hold. I don't know. I would be suspect of that myself. All right, so let's look at some of the international markets, and obviously we want to see how Canada's doing really well. And I had talked about this last week. They broke above, and I felt like, well, since they blew right through that resistance area here at 40 in an overbought condition, that the best scenario would be to come back down, test 40, and then move higher. And that's exactly what happened. And the Canadian market has just, the EWC at least, has gone sideways here as we've consolidated above 40, moving back to the upside today. Man, that is ideal price action for the EWC. We're in a wave 3. You take a look at the DMI. Man, if that ADX can make it above 20, see the separation starting here between the 2 directional indicators, but the ADX has to get above the negative directional indicator, and it has to get above 20. If those 2 things happen, we could really be off to the races in the EWC. Hasn't happened yet. It's not triggered yet. So far, that's really good price action. But the DMI, if you haven't watched me much before, is one of my favorite confirming indicators to Elliott wave. And with a wave 3, if you get a confirming DMI, that is a really powerful scenario. So a good solid wave 3 with a confirming DMI, that's a trade that you want to consider putting on. We aren't there yet, but if it does happen, man, that could be pretty powerful in the Canadian market. So for those of you watching in Canada, keep an eye on that, because things could get really, really interesting moving forward there. So let's take a look at the XJO. As we noted in the last update over the weekend, we had a really nice break from the triangle, and that break has continued. Look at this. This is, if you wonder why we have the volatility portfolio at Elliott Wave Options, which is full of strangles for triangle patterns, well, take a look at this. This is why, because this happens all the time. You can see this triangle pattern on the XJO, which is the ASX 200 in Australia. So that broke out, broke to the downside significantly, actually went further than was forecast based on the width of the triangle. Then we came back and retraced that triangle. That's exactly what's supposed to happen when you have an Elliott wave corrective triangle and you get a breakout. It should retrace. It doesn't have to happen immediately like this one did, but eventually it retraces. So it did, and then it moved into a larger triangle, created this giant triangle, and look at that breakout move. It doesn't get any better than that. You had a really well-formed triangle. We talked about that, and the breakout has been significant, and that is impressive. And then when you look at the DMI, it doesn't look like it's done yet. Maybe we continue higher and we get up to the point where, does the ASX move to new highs? We're not that far away. And looking at the DMI, I think there's a pretty decent chance that that's what occurs, that we do move and make new highs in the Australian market. So Canada's looking good. Australia's looking good. They're all leading the US. The US market charts, even with that vertical rally that we've had, are not as impressive as either Canada or Australia. Both of those are really, really impressive charts. So we'll look at the Nifty real quick. We'll look at the DAX real quick. And we've had this big triangle here in the Nifty, and I would submit to you that that continues. So no real significant move out of the triangle formation of the Nifty. The ADX is moving down, and as it gets down towards 15, the lower the ADX goes, normally the sooner you are towards a breakout. So having the ADX dive down towards 15, it gets below 15, even close to 13, then we're probably going to have some sort of a breakout move. But for now, you can see that the wave 4 is right at the 61.8% level, but we have this symmetrical triangle, and even Elliott himself, triangles trump everything. So, and then Elliott would talk about, if you have a triangle and an impulse move, that the triangle breakout is likely to be in the direction of the impulse move. But I'm a bit more conservative than that. When you have a well-formed triangle, I like to say that you need to cover both directions. So we'll see which way the Nifty breaks from here. And then the DAX, so we'll take a look at the DAX, and you can see that right up to a 50% corrective move in the DAX, finally starting to get some bounce, but we have that wave 5 forecast lower. We got a long way to go to disqualify this 5-wave pattern to the downside on the DAX. And if you're newer joining us, this wave 3 has been relabeled 3 times. So we had a wave 5 that relabeled to a 3 times. So Elliott wave has just nailed this entire downward move in the DAX. You can see this zigzagging all the way down. And every time we went down to a wave 5, it relabeled to a 3, we bounced up and made a new low. And so is that going to happen again? Well, we'll see how it plays out. But for now, we're at a point of potential resistance here at a 50% corrective move in the DAX, and also right there at 30, there's resistance. So if we can power through there, that would be impressive. But we got to do it first. It's got to show us the Missouri show me type of scenario. So then let's look at Bitcoin. Pretty impressive bounce that we've had in Bitcoin. And we talked about how breaking out of this triangle, and man, look at that. So we had this really nice symmetrical triangle. And then over the weekend, we talked about how Bitcoin broke out of that, but then it morphed into an ascending triangle. So we still had to be caution to that, but we've broken out of that as well. And so now we're up testing that 48,000 level. And you know, the 4s that have to do with Bitcoin, if you've been listening, everything is in stages of 4,000. 48,000 is resistance, 44,000 was 40. Then you drop down to 36, 32. Everything is in 4,000 increments as far as support resistance with Bitcoin. But you have this nice bounce to the upside. Now we still have a 5-wave impulse pattern to the downside, and we're at a 50% or close to a 50% correction. Can we get through 48,000? If we can get through 48,000 and disqualify this wave 4, well, then we're going back to the all-time highs on Bitcoin. That's what'll happen. We'll go up to 68,000. Bitcoin has some work to do because we have some resistance here. 48,000 at the time of this recording is trading right here, right around 47,000. So it's kind of bumped its head at that 48,000 level, but that was impressive moving up to that level. Can it hold it? And that's going to be the question over the next few trading days. If the market does retrace a bit, does Bitcoin hold, or does Bitcoin start to move back down? So the key word here for Bitcoin is, can it hold 44,000? If it pulls back after bumping its head at 48, 44,000 is now support. It broke through it. It was resistance. It's now support. So if we move back down, can it hold 44,000? If it can, then we have a chance of coming back down, testing that level, and then maybe moving up to new highs. A lot of work to do for Bitcoin. That's a possibility though. So we're going to be watching closely how Bitcoin handles 48,000. But we talked about the triangles, and it broke out of both of them, both the symmetrical and the ascending triangles. It broke to the upside. Pretty impressive stuff there. So taking a look at TNX, which is the 10-year, and talking about how money has moved out of the bond market. You can see this move up here. Now, money started moving back in today. So was that an early move into the bond market? Is money coming in internationally? Why did we move to the downside today in rates when the equities market moved to the upside? Going to be interesting to see over the next couple of trading days. We were a bit overbought on the 10-year, but we were overbought on the SPY as well. But the SPY managed to go to the upside, but the 10-year started to come back down. So what's going to occur there? Well, here's the chart that I wanted to really show you that concerns me a lot, and that's the dollar. And you've heard me talk about the dollar, and if it were to break to the downside. So we had this really nice symmetrical triangle, and how many times, those of you that have watched these videos, how many times have you heard me talking about a follow through or confirmation day? A lot, if you've been watching. This is exactly why the dollar broke to the upside out of the triangle. When you break a major point of resistance, a support resistance area, or out of a triangle, you have to have a follow through or confirmation day. It didn't happen. So you got a false breakout to the upside on the dollar. So we get 1 day's move that sucks people in. Those are head fakes that occur in the market all the time. That's why I'm constantly talking about you got to have the follow through a confirmation day. It didn't happen. Now where's the dollar? Now the dollar's down below the point of the triangle. We're not down to 97 yet, so everything's okay. And there is a chance that we could be just simply creating a larger triangle in the dollar. That's what I hope is happening. I don't know that that's what's happening, but often when you have a false breakout one direction and a false breakout the other direction, you're creating a larger triangle, because there's no such thing as two false breakouts. You can have a false breakout one way, but you don't have two false breakouts. It creates a triangle. Now, I'm not saying the downward move is a false breakout. We don't know. We won't know till tomorrow. But if we bounce back to the upside in the dollar, then that shows that it was a false breakout. It just means we're constructing a larger triangle. But if we do break down and we do follow through in the dollar, I'm really concerned that we need to hold this 97 level, because with everything that's going on, everything that's occurring with the Federal Reserve, the yield curve, you probably heard about that. I'll show you the yield curve. The 210 inverted today. That's the one everybody watches. A lot of the denomination pairs had already inverted, but for a brief time today, the 210 or 10-2, however you want to call it, inverted. And that is one of the strongest signals of a pending recession that there is. And already there were people talking about, well, it's different. It's different this time. And you heard me say, when people come out and start saying, oh, it's different this time, it's not. It's never different this time. It's a strong signal. When you have an inversion in the yield curve, you're going to have a recession. And at least historically, that's been true. And that occurred today. So you can see the yield curve here. You can see the back off and all the denominations there that inverted. But with the 210 inverting today, that's, even if the yield curve does start to widen. So looking at financials, that is not a place that you want to be. Commodities, likely a place that you want to be moving forward. But financials, if there's no yield spread, they can't make any money. They need the widening of the spread to make money. When there's no spread, if they're borrowing and lending at the same amount, they're not making money. So that's why the financials have been underperforming a bit. So back to the dollar, I'm going to be watching this closely tomorrow. Can we bounce back to the upside and form a larger triangle? That would be a sense of relief for me personally. But if we break down and confirm this downward breakout, well, then I'm going to be watching 97 very closely to see if we break that level. If we do, I'm going to be really concerned about where things are, not just in the US, but globally. And there's been some speculation based on what's been occurring in the fixed income market that we could have some more financial issues. Are we going to have anything like 2008? No, I don't think so, because they've got all these stress tests and the financial world is in a lot better shape than it was back then. But if we're having inverted yield curves and we go into a recession, things like that are going to be tough for the financials. So could some companies struggle? Yeah, they could. But are we going to have another great financial crisis? I don't think so. I don't think it gets that bad. But probably not a sector that you want to be involved in. Maybe something you want to stay away from, unless we start to get a steepening of the yield curve again, and we start to get some separation between the denominations, so the financials have an actual chance to make some money. All right, so that covers the markets that we go through that I wanted to share with you. I do want to show you one of our case studies that we closed for our subscribers, and this is in the new AI. If you've been listening, we have the new AI strategy. It is artificially intelligence based. It selects the percentage of stocks staying in a trading range. So we have a stock that has a big drop, and the AI tells us the likelihood of it staying in a range, and we can take advantage of that sideways move through a calendar spread, a diagonal spread, or a butterfly. In this case, it was a butterfly. And you can see, look at this, 50% gain in a butterfly in 17 days. Doesn't usually happen that you can get that kind of a gain in that short of a time frame. It usually takes a while for a stock to stay in a trading range. But see, what happens when you have a stock that moves down is you get a spike in volatility, and you get the benefit of time decay as well. So the entry point here with the move to the downside, and you can see this was about as good of a setup as you wanted. There was the earnings report date that caused the stock to move to the downside. So we had a gap lower and a gap higher. So the likelihood of moving within this range between 30 and 20 was very strong. Maybe we come down and fill the gap at 20. Maybe we go up and fill the gap at 30, but breaking either of those two levels, because 20 was support, 30 was resistance. I mean, it was just a great setup for a butterfly. It really was. So why do you use a call butterfly versus a put butterfly? Well, do you think the stock is going to stay likely below the midpoint or above the midpoint? If you think it might eke above the midpoint, you might want to consider a call butterfly. If you think it's likely to stay a little bit below it, you consider a put. We chose a put butterfly based on our mathematical spreadsheet, and that worked out extremely well. And then here's where I made a comment on this to our subscribers, explaining it a little bit more. We do send out commentary, as you can see, on the alerts that go out, but it's brief because we really want to get this sent out and get the alert in the hands of our subscribers quickly so they can follow along with it if they want to. And so then the close date was on the 25th, and a nice 50% gain there that occurred in 17 days. And in the AI time strategy, around 21 days has been the average. Some are shorter, some a bit longer, but somewhere in that 3-week strategy. So if you're looking at a 3-week strategy where you can generate some income, this isn't going to be one of those home run things. We're not going to get a 500% gainer in one of these, like if you get a directional move right. But the drawdowns are very low. So if you're risk conscious and you don't like seeing drawdowns in your account, then the time strategy is something that might interest you. But there's a really good example of it using the butterfly, a great example of it, and it played out extremely well. So I thought I would share that with you. And CCXI is still in the trading range. In fact, take a look today. Pardon me. CCI closed at 25.71 today. So slightly above that 21 or the 25 level, but still staying in the trading range. So it looks like our exit was a really, really good one. Now, if it stays around 25 or lower all the way to April expiration, you can say, well, you could have had a grand slam trade, because that's the issue with butterflies. They're so low risk and high potential reward, but it has to stay in there for a while. Would you take a 50% gain in 17 days? I think most people would. We did. And so I wanted to share that with you. If you've been hearing about AI-based trading, CNBC's been talking about it. I think it's the future of technical analysis. We feel like we're kind of on the leading edge of that. So take advantage of it. We have some really good offers there for our time strategy. at EWOtrader.com. All right, so let's go back and review some of the case study considerations that we've had in past trade finders. Now take a look at this, where we are now. So this was on February 8th, and this was a financial. And I just got done talking about financials, and you're wondering, well, why didn't it continue to the upside? Well, if we go back and look, we can see, wow, it had a wave 4 correction there of 50%, a wave 5 potential target, but boom, at this point in time, we came down and made a new wave 4 low at 60%. So that's held so far, but can you see the pattern? If I were to take the Elliott wave off, what's occurring here? A big triangle. So I think what you want to consider doing, especially when you take a look at the DMI, look at where the ADX is. It's down below 15, right around 13. So I think you would want to, if you're still following along with this, you would want to morph this into a strangle with the low ADX. So you take it. So if you were long it, then you add some puts. So you balance out your delta. So where it breaks from here could go either direction. That would be a great consideration. So I'm going to make a note here that we're taking the FITB that was a long consideration from February 8th, and we're morphing it into a triangle. So a strangle for a potential breakout either direction. We'll see what happens in the bond market. I think is going to really determine what occurs with the financials, but a really good example of what's changed with the yield curve, etc. And then Vivo. Last week, we talked about, look at the triangle that was forming. So let's just go back to last week. So if I just walk this back a little bit to last week, we were right there and we looked at this triangle. Now this is a different scenario. Why is it a different scenario? Well, when we add in the DMI, you're going to see that we don't have a low ADX with this like we did in FITB. And we talked about that last week, that with the ADX that high, you don't really want to change this into a strangle, because with the ADX that high, it could continue to go sideways. The low ADX is telling you that the stock has been consolidating for a while and it's likely to move. So we said that we would be better off just saying, hey, we get an upside breakout and continue the upward move. And that's exactly what happened here. Pretty amazing what's occurred. So if we go back and look back on Vivo and go back to the first. So let's go all the way back to first here. We closed at 25.26. Look where we are today, 26.49. We're up $1 from where we were when we put this on, and it was a bullish position. So it's not a point where you probably want to take it off, but with a wave 4 corrective move at 50%, moving to the upside, wouldn't take too much more of a move to where we usually like to see a 10% move. So we've had $1. So another $1.50 move, you take the gain on that and move on. So that may be one that we get rid of next week. And then last week, we looked at putting on another strangle on silver, but this time we picked the miners SIL versus SLV, which is actually the metal. And you can see here, and we did send this out to our alert subscribers as well, because the ADX was lower and the pattern was slightly better than it was in SLV. So when you take a look at that, it's a pretty well formed pattern, nice symmetrical triangle. And what's happened since then? Now look, remember when I said you don't get two false breakouts? What happened? Tell me what's occurring here. I just went through this. So hopefully you're saying it's creating a larger triangle. That's exactly what's happening with SIL. It's creating a larger triangle. So that's the formation now. So what we would do is take off what we saw last week and we would change it. That's the pattern now. So could it go sideways for a few more days? It could. There's a little bit of room there. Does it have to? No, it could break out any time from there. But you had a potential false breakout to the upside, no follow through, potential break to the downside, no follow through. It's creating a larger triangle. Now, the frustration with creating a larger triangle is it takes longer for it to move. And you watch and you see time decay ticking away in your account before the move occurs. So you see red in your account and then it breaks out and then all of a sudden it turns green. But it's frustrating to see the red. The positive is when you form a larger triangle, usually the patience pays off because you get a larger breakout. If it's a larger triangle, you get a larger breakout. which means you have the potential to make more money. So little frustration, little patience required for that frustration, but it usually pays off. So that's it. That's all we have left as far as the case study considerations that we've been looking at over TradeFinder. And we do this each and every week. So if you've been following for months, years that we've been doing TradeFinder, then you know that our record on these case study considerations is pretty darn impressive from picking those that have done well. We've only had a handful of those that we looked at and said, hey, you might want to just consider taking that off at a loss. They've been few and far between compared to the ones that have done well. All right, so at this point, we need to find one for tonight. Well, I'm not going to go through the normal process of searching and going through our indicators. If you watched before, we have these scanners. The software program, by the way, is called Profit Source. People ask about that every recording. They did in the last recording as well. People see how clean the charts are, and it's really impressive. Look at this. Holy cow, 17 impulse stocks to the upside. I'm cautious on that. I know the patterns are becoming qualified, but the fact that the markets move so vertical, I'm a little bit cautious on being long right now. I like more of the idea of some sort of a retracement, at least a 38% retracement. So, Zach, I don't know if you were able to create a poll or if you just have been watching the comments that have come in, but this is going to be a case study by committee for tonight. So for tonight, for 329, which of those four markets that I mentioned are going to be the ones that we're going to buy puts on? So it's going to be a downward move that we're looking at for the next week. Might be wrong, but I just feel like we've moved too vertically to the upside. The charts, when they go straight up like that, often come back and retrace a bit. So Zach, if you're there, we can get the results of people's votes, and then we'll open it up for questions.
Sounds great. Yeah, so tons of votes coming in. Thanks again, everyone, for voting on both Zoom and YouTube this evening. So starting off for our winner, we have the SPY. Close second was going to be the triple Qs, followed by third place for the IWM and fourth place of the DIA. We did have even a few votes for all four as well.
Yeah, cheaters. Cheaters. I understand that, and I feel the same way. And the vote kind of played out the way I would have expected. I wouldn't have been too surprised if the Qs were first and the SPY was second. But I felt like the IWM would beat out the Dow, because the Dow did consolidate a bit more. It's not quite as vertical. So, hey, I'm pretty impressed with the responses from the viewers. So I think that's showing us as a very educated viewer base that we have tonight. So really impressed. So, okay, the official case study consideration, because I make notes of these, we do track them, is going to be puts on the SPY. We'll see how that plays out, not just over the next couple of days, but when we get together again next week. All right, so we got 10 minutes to go. Let's take some questions.
Sounds great. And so we'll start out with this first one here from Mike. How do you feel about an in-cycle melt up beginning soon? The declining volume in recent days resembles the beginning periods of large gains in 1999, 2007, and 2020.
There's been a lot of comparison to 2007 and 2008. And there is some people speculating that based on what's occurring with the fixed income market and the signs that are being shown and the drop off in liquidity, that we could have some financial issues. Again, not the same thing as what happened in 2008 with the great financial crisis, because financials are in better shape with the stress tests that were put in place, et cetera, to avoid that from ever happening again. I think we've had the melt up. I mean, that's an awfully vertical move with low volume, with the Federal Reserve going to be raising likely 50 basis, and they're buoyed now. So people that think I have a disagreement with the viewpoint of, well, it's doing their job for them, and so they don't have to raise rates as much. I think the fact that the markets move to the upside like this gives the Federal Reserve more confidence that the market can handle the 50 basis point rate hikes. And I think they're going to go 50 basis points at the next two meetings, at least at the next one. And I just don't think that's going to bode well for the market moving forward. I think there's shenanigans going on right now. Then we have the rebalancing over the next couple of days. It's going to take into the first week of April for things to really settle out and figure out where we are. So I think it's a difficult market to trade over the next few days, other than, trying to take advantage of what looks to be an overbought scenario in the markets. And that's what we're doing with our case study consideration. But I feel like that the melt up has occurred and is running out of steam. Now, I could be completely wrong. Often impulse moves start on low volume. So the fact that we've had a big move to the upside on lower volume, that happens all the time, but not this far and this vertical. I mean, we're not that far from all-time highs, but the world has changed. The Federal Reserve is not going to be pumping in the liquidity. They're going to be pulling it out, and there's no way the market can continue to go the way it has without that liquidity. There's no way. It just won't. So do we get to new highs first? Well, we could. It's what, March 29th, and they're not going to start reducing liquidity until May. So could we technically break out that high? It's possible. I don't think that's going to be what's happened, but it could. But I really think that the majority of the melt up has happened. So I don't know. We'll see. Just my opinions, but that's an awfully vertical move that we've had so far.
Yes, indeed. And just to add a little context to that, I'd say a lot of the SPY votes were in regards to how vertical the market is, the SPY is, and that was the main reason behind their vote. So moving on into a question from YouTube from Hold My Bear: low caps fall, big caps move up?
Well, typically, you're either looking at small caps or you're looking at value. I mean, we've had an alert on the XLV, which has recovered really nicely out of this bounce to the upside because of value. And, it's done well, even though money has actually moved into some of the more beaten up areas, the Qs, technology, et cetera. Again, even I mentioned even the meme stocks are back. I think that's what the shorts want. The shorts want people to feel that it's okay to jump back in the water. Sharks are gone and the water's safe. Then you can come back in and swim again. And then they show up and turn things around. When are they going to show up? Nobody knows. We'll wait and see. I don't think it's that far away with the signs that we're seeing of the meme stocks coming back, et cetera. So yeah, normally you're moving towards the large caps, which are viewed as more value, or the small caps, which are viewed as more risk, taking on risk on type of environment. So, perhaps the Dow is going to be the best performer moving forward. I think that's highly likely. And that doesn't mean the Dow is going to be moving to the upside, but the Dow outperforming the SPY and the Qs, I think, and then the IWM for the small caps, I think is likely. If the IWM gets a follow through and starts moving higher, then yeah, you have to respect the fact that this market's going higher, whether it makes any sense or not. That's what's happening. But it has to do that first, and it hasn't yet. Next week we'll know. Good question.
Yes, indeed. And so moving on back over to Zoom, Constantine says CCI for DIA shows divergence on daily. How big CCI could go? Thank you.
So yeah, the DIA, and the only reason I thought that one might sneak in there is because of the doji, but I understand why our viewers saw this consolidation, that it's not as overbought, and that is absolutely 100% true. So, I mean, this is happening on the SPY as well, right? The CCI is really high. It can stay in the upper threshold, it's called, for a bit. But when you get to the point where you're at a extreme point high, which is where we are in all the markets on the CCI, at some point you're going to come back to the downside. And so we did move back down, and look at that move down in the CCI when we went sideways. So there's where the divergence is, I believe, in what's being noticed is the fact that we went sideways up and we're actually lower on the CCI. So you can see that from that extreme point high to the high here is lower, but the market is higher. That's the divergence, I believe, that the question is asking from Constantine. And, divergence always works. So it's an early signal. It tells you when things are going to change. Something has to happen. Either the CCI comes back and confirms this move, or the move in the market retraces. One of those two things happens every time you have divergence. That's why people look at it and watch it. It doesn't stay divergent for very long. So again, either the CCI breaks the extreme point, confirms this move, or the market moves back down and verifies the divergent move in the CCI. So good observation.
Absolutely. And thanks for that, Rob. So moving on to this next question from Susan, just to preface this, I'm just reading it word for word. Susan says, dumb question. Since the ES SPY futures trade overnight, can an expected move occur and change or mess up with an expected move the next day?
It happens all the time, Susan. And, it didn't used to. There's more trading after hours now than in any time in the 25 years that I've been doing this. And, it was quiet after hours most of the time. I never stayed up half the night like I do now watching the futures market because things change rapidly. Obviously, what's going on with Russia and Ukraine with the time zone changes, watching Europe open, watching the Asian markets, all that stuff. Watch all those things. And there's still less volume overnight in the futures market than there is throughout the day. So what happens in the futures market can be changed, and it happens quite often. But I'll say there's more movement in the futures market than I've ever remembered seeing in the past. And so that makes it really interesting to see how that corresponds into actual, trading hours when the market opens. But yeah, it's a different world.
It sure is. And thanks for that question, Susan. I thought it was a good one. And I'm sure others that were listening were wondering as well. Always good to have a refresher there. So Pabs from YouTube says, do you see Amazon going down?
Wow, I was waiting for somebody to ask about Amazon. To me, Amazon is kind of the bellwether. Now, I was talking about how money had moved into some areas where it hasn't been, and retail was one of them. Retail had been struggling throughout the beginning of this year. But Amazon, is there a better retailer? Lulu did good today. Lulu's making shoes now. They're going to come out with shoes. Are they yoga shoes? Is there such a thing as yoga shoes, or are they leisure shoes? I wasn't really clear on that, but some people doubted when Lulu went into menswear, and that was a smash hit, especially when they timed it right before COVID. It couldn't have been any better timed, and so their athleisure with the menswear was extremely well received. We'll see how the shoes are, because Nike reported good earnings as well. So the retailers are doing well. My concern with Amazon is it's too vertical too. That's just too vertical. And, I stand by what goes vertically up. See, look, there it is right there. When it goes vertically up, what happens? Often it comes vertically right back down. And so I think we have to be aware of that. Now, does it have to come all the way back down? No. So I want to be clear on that. When you have a vertical move, it doesn't mean the entire vertical move gets retraced. It does often, but it doesn't have to, and it doesn't all the time. But what I do think is that we need at least a fib level, a 38.2% fib level correction if we are off and running. And so when we look at this is where we were with this big triangle back at the end of last year on Amazon. And so we've retraced that move. So look where we are. We're right back to the breakout point of that triangle. So where we go from here, if Amazon can go higher, that's a good sign for the market. But if we continue to the upside with that vertical move, a lot of things that I've learned and come to believe over 25 years are going to have to come into question if these vertical moves continue to go vertically and don't get retraced at all, at least a fib level. So can Amazon go down? Yeah, Amazon could go down based on that vertical move and the fact that it's retraced this breakout from the triangle. So it's at its point of, okay, what are we going to do here? Show me what you're going to do from here. We'll see. It doesn't have to retrace the entire move, but some sort of a correction, I think, is warranted in a lot of different stocks. And then you can see the separation there from the 10-day moving average with Amazon as well.
All righty, thanks for that, Rob. George would like to look at VNOM, VNOM.
VNOM. Hey, anything energy is interesting right now, isn't it? There's been a little bit, of a rest here, and I think looking at oil, I'm going to come back. I promise I'll come back to VNOM, but I wanted to show this because this is likely going out to our subscribers fairly soon too. I don't know if it's ready yet, but look what's happening in oil. Remember when I said I was totally wrong on oil because we had this vertical move and we got the vertical, say, there you go, vertically up, vertically back down. And then I thought from that point, after that occurred, we'd go into more of a 45-degree angle. Didn't happen. We went vertically again. And then what happened? Vertically back down. But now what's happening is we're forming a triangle. So we're getting a very nicely formed symmetrical triangle in oil. And if we can go sideways for a few more days, man, that's an interesting trade. I think putting a triangle on oil makes a whole lot of sense because it could go significantly up from here or significantly lower with oil right around $100 a barrel. So I think that could be a very interesting trade. So I wanted to mention that earlier and I'd forgotten. So when the energy position came out here, I wanted to show that. But this is moving exactly the way you want it to move. I like this pattern so much more. There's my 45-degree angle. Those tend to hold. They don't get as severe of corrections. Everything gets a correction, right? That's what Elliott wave is. It reveals the impulses and corrections. But when you go on a 45-degree angle, the corrections are less severe as when the corrections are coming from stocks that move more vertically. So when we look at the DMI, it's not confirming this move yet. But if it could, then we could go higher from here. But I would want to see, for me, to go long from this point with a 81% extension already in the wave 5, I would want to see that ADX continue up. And then that positive directional indicator came back down because of the, a little bit of a corrective move, slightly overbought here following the close on the 25th. But I would want to see some confirmation here on the DMI before I went long on this. I still think energy is a good place to be this year. Natural gas, everything. I just think all those things make a lot of sense right now. In fact, let's look at a chart of natural gas and talking about some significant exporting. I had mentioned back when we had this move here, we caught this move. And I was saying that, well, I thought when the war broke out, we would come up and test these highs through here with natural gas. And we didn't do it back then, but I was just a little bit early because then we had this big spike here on the 2nd of February. And now it looks like we're trying to run back up. And I don't think it's going to take too long before we are at those highs. So I just was a little bit quick on saying that, oh, I thought we would test those highs and we didn't. It's just taking a little longer for the move back to the upside. So I think that's a place to be as well. Commodities, all that stuff. That's going to be this year, I think.
Absolutely. And
all right, we're after hours here, Zach. But let's take a couple more if you got them, and then we'll wrap things up.
No worries at all. I was just going to say I'm happy to stay on as long as you are. So you tell me as soon as you're ready to wrap things up. So I'll pass you a couple through.
Yeah, let's do 2 more. And
all righty. So Yolanda from YouTube asked if it was time to short Tesla.
We did. Yolanda, I'm totally in agreement with you. We sent out a trade for a put spread on Tesla to our subscribers. So totally in tune with that. And it's because of this gap up. So the tweet from Elon Musk saying that they were looking at splitting the stock. They've gone to try to authorize additional shares to split the stock. And so we've got that gap up in this vertical move. And our position is just filling this gap. So, you know, if you wanted to stay longer than that, again, straight up, too vertical. It's too vertical of a move, a gap up. I thought yesterday's gap up, that's when we sent the alert out, might be a blow off top. It did manage to close a little higher today with the market, but that's too vertical. And with a gap, we're looking for it to come back down and close that gap. That's all we're looking for out of our trade. But that vertical nature, I think, you know, a short term, now I don't know about the long term, but a short term short on Tesla makes a lot of sense right now, at least till that gap is filled. But, you know, there's speculation of in the future, how many, somebody did the numbers, and it's an insane number of cars that Tesla has to build every year to justify their market cap. And it's never going to happen. They're never going to create that many cars. Everybody loves Tesla stock though, so it holds in there. It will come back to its fundamentals someday. Stocks always do, but we focus on technicals because Tesla is a perfect example of how, you know, if you stay at fundamentals, you would have been short Tesla for a very long time and gotten your you know what handed to you. So, but at this point, that's an awfully vertical move, and yeah, I think it's a good time to come back down. Totally with you, Yolanda.
Absolutely. And so for the last one for the evening will be from Chris from YouTube. Thoughts on Apple? I'm actually shorting it and looking for it to revert to the mean. Lots of shorts this evening.
Yeah, well, I think everybody, I mean, a lot of people are calling this the most hated rally. That's the only thing that makes me nervous. When everybody hates a rally, then it's likely to continue. But these moves are just too vertical. Had we just taken off of these lows and made this run this way, I would say this is going to hold. Believe it or not, this is going to hold. But with these vertical moves, it just historically they pull back. Now, it doesn't mean again the entire move has to pull back, but they pull back. I think Apple needs to come back to 170. So I think there's a bit of a short there. As far as moving further than that, I've always said that Apple is one stock I would be very hesitant to short because they have so much money. It did make it down to 150 at the lows when the market hit its lows. I don't know that we go back down there again. But is it a short right now, short term? I think so. And I think it needs to see 170, and I think it will see 170. So I think that's a good call, albeit shorting, you know, one of the most fundamentally sound stocks that we have, but that's just too vertical of a move. It really is. So, man, great questions, great stocks, stocks we hadn't looked at in a while. This is a wonderful session, I think. So I hope everybody enjoyed it. You know, I talk about this when they sign off every time. Time's the most valuable asset we all have. And we very much appreciate it when you spend your valuable time with us. And we do our best to make that an informative and educational use of your time. Thanks, everybody. Appreciate your attention.